Welcome, viewers. My name is Paritosh Basu. I am a member of the Institute of Cost Accountants of India since 1978. Essentially, I'm a fellow member. I'm a member of the Institute of Chartered Accountants of India. I did my master's in commerce from Calcutta University, and I have also done my PhD from Calcutta University. Of course, I did my PhD from Calcutta University in 1999. After 35 years of working in corporate houses in various capacities, last two being Global Group Controller and CFO of uh, two large MNCs of India, I have joined teaching. I'm a senior professor of NMIMS School of Business Management, Mumbai, as you can see from the PowerPoint presentation. While in corporate, I I used to do a visiting faculty members assignment. But back in 1989 to 1994, I have taught in Calcutta University uh, as a visiting faculty member on Fridays and Saturdays in the evening program. And then I got transferred to Bombay when I was doing my PhD after 20 years of my CA, ICW, and MCOM. I started teaching as a visiting faculty member of this university where I'm teaching as a full-time professor now. After finishing my corporate life, I joined teaching and training. As you could make out by now, that teaching and training is part of my passion, and hence I'm here with you. This is a session which is a knowledge pool series session. This session has been requested for me to be given to you, delivered to you, as a matter of a resource pool of various video records on certain subjects. I'll be giving you altogether 4 subjects, and today is my first session. My topic is basic applications of cost and management accounting. And within cost and management accounting, I'll be talking about basic applications of cost management tools and techniques. I understand that the audience who will be seeing this resource full of videos will be mixed people, certain people who will be just coming out of their standard 12 and joining the course. Certain people would be intermediate cost accountants, certain people will be full-time, full-fledged cost accountants. Perhaps they will be seeing it for some other program of the institute. So essentially, the standard that I will maintain will be having both an elementary standard on certain slides, and there will be uh, upper level standard going forward. But I'll try to build up my session in a manner that you can carry yourself along with me, or I can carry yourself along with you. As you go forward, since there is no scope of interaction with you, I'll request you to connect with me. You can see my name here, Dr. Paritosh Basu. I have about 14,500 plus connections in LinkedIn and about 1,300 plus connection in Twitter. So if you happen to see my presentation, and thereafter, if you have any query after the institute uploads it into the knowledge pool, you can connect with me in Twitter and LinkedIn, and we can just be in touch. Okay, so let me start my basic application of cost and management tools and techniques. I'll be trying to go a little slow, and I'll be also trying to give you a lot of examples from the industry and my practical life experiences. Let me see how I can make the session as far as practicable and possible. Since it's a digital class, I thought that I'll be showing you a couple of videos, but time is only short, 2 hours, and I have to cover quite a lot of areas. So videos I am not showing, but I'll try and give you quite a bit of examples as I go forward. I'll be using a lot of graphics which are available freely in the cyberspace. So I acknowledge to the people who have created those graphics. I'll be using only for my knowledge propagation purpose. You can see here a pyramid, and this is the pyramid of accounting and reporting function in a changing environment. Every single day in a business organization, certain economic event happen. An economic event happen, that means a transaction happens when an organization gains certain thing and sacrifices the same thing. For example, when an employer is employing a person to his company, he is buying the time of the person. That means the person is selling his time, that is his sacrifice, and the employer is making payment, that is his gain. So this is called an economic event because a money is sacrificed by the employer. An equivalent of money is gained by the employer, that is the organization. So what do we do when this kind of transaction happens in a company? We measure the transaction, we recognize the transaction in our books of accounts and record it at a value, and then report it. When we report it, of course, we do not report every single transaction. We report in the form of profit and loss account, balance sheet, cash flow statement, etc., etc. But for whom we do report? We do report for stakeholders, our governance group, that is board of directors, CEOs, CXOs, audit committee, etc., who are our governance group, and the management also, that is the managers of the business who run the company. So we report, record, and collect transactions. We do the reporting for the senior management and the governance group. When we do all this, we do not follow our own whims and fancies for accounting. We follow certain framework, like accounting standard is a framework, legal framework we follow conceptual framework, we follow regulatory framework, like banks accounts are prepared following the Reserve Bank of India's guideline, and we follow certain legal frameworks. Like SEBI tells us about certain things which are to be disclosed in our accounting statements. So we follow all these four frameworks: conceptual, institutional, regulatory, and legal. And we report this. We ideally report it monthly: profit and loss account, balance sheet, and cash flows. At times, we report certain things on a daily basis, like certain organizations have a system of reporting today's sales tomorrow morning to the CXO. At times, we do report weekly, at times, we do annual. So we keep reporting. But the objective of all these activities is that we want to take the organization to the pinnacle of success. That is, we want to continuously have decisions taken based on the information we submit to management, and the decisions are essentially to meet certain challenges, avert certain risk, and sustain the organization to the path of prosperity. So we are here for discussing on cost and cost accounting. So I'll just lay the foundation in the form of financial accounting, because cost accounting collects most of its information from financial accounts. At times, cost accounting and financial accounting are integrated with each other. At times, these days, it is mostly integrated because we have ERP, Enterprise Resource Planning, we have SAP, we have Oracle Financial, we have many other ERP systems. So in these days, there is no accounting and recording wise, there is no hardcore compartmentalization between cost accounting and financial accounting. But when we do cost accounting for certain reporting purposes, and in certain industry, cost audit is also completely mandatory. So in those industries, the cost accounting is done on the basis of 19 cost accounting standards and certain management accounting guidelines on the basis of the standards and guidelines issued by the Institute of Cost Accountants of India. So this slide, I'm trying to make you understand that cost accounting and financial accounting go hand in hand. Essentially, in terms of managerial decision, financial accounting stops and cost accounting and management accounting takes over. That's the kind of situation. So when you say accounting, accounting is the process of identifying, measuring, recognizing, and reporting economic events. Your objective is to facilitate the process of informed judgment. That means when you report your financial statement of the month, either it is as per expectation or above expectation and beyond expectation. Suppose it is below expectation, then the management would be helped by your reporting to take certain corrective actions so that next month the actions yield into better result. So that's the accounting purpose. But cost accounting has a little different purpose. This is a process of accounting by which relevant data are collected, collated, classified, analyzed, reported, and interpreted. In financial accounting, you know that the all expenses and incomes, assets and liabilities are journalized, put into ledger, and all incomes and expenses goes to profit and loss account, all assets and liabilities goes to balance sheet, and you do a cash flow statement. Your financial statements are ready. Of course, you give many notes to accounts for clarification of those numbers. But cost accounting does a little different. It goes much beyond in terms of collecting, classifying, analyzing, and interpreting the data. What is the objective of that? Our objective is to discharge 5 functions by cost accounting. First function is the identification of cost. Second is ascertainment of cost. When I say identification of cost, in a factory, suppose we have a dispensary where there is a doctor, there is a nurse, there is a compounder. Now, these doctors, nurse, and compounder, they get salary from the company, but their salaries are not debited to salary account. Their salary is debited to welfare expenses because the dispensary or the first aid center is maintained in a factory for the purpose of welfare of our people, to take care of accidents, etc. So we do identify our expenses for certain purposes. Then we do ascertainment of the expenses. That means when we do not book our expenses everything in one place called cost of goods sold. We make them into material, we make them into labor, we put them into overheads, etc. So certain expenses we incur which are common expenses, which are not directly allocated to a product. For example, a company, suppose a plastic molding company, in one part of the factory they make chairs, the other parts of the factory they make buckets. And the factory costs, certain things are common, like electrician cost is common, like factory building cost is common, maintenance cost is common, procurement manager salary is common. So when we do costing of the bucket or costing of the molded chair, we have to allocate those costs. Then we have to do apportionment of indirect cost. For example, we have a head office, suppose in Bombay, and our factory is Daman. So the head office costs are also to be apportioned on the product, because unless we recover all cost of our company through our product, that means our prices do not cover all the cost, we are not in a position to make profit in the entire company. So we have to apportion certain expenses which are not directly related to production. Then we do assignment of non-related costs. For example, suppose we run an R&D, a small R&D center in our plastic molding company. What all new things we can produce, or how plastic variants can be used for making things tough, or for that matter, anything to do with improvement in quality and quantity, quality and speed of our operation. These R&Ds doesn't have any link as of now connected with the production of buckets and chairs. But those R&D expenses are also to be recovered through our prices. So what do we do? These are non-related expenditure we do assign to our product. So cost accountants do all these jobs of identification, ascertainment, allocation, apportionment, and assignment of non-related cost. Then what is management accounting? So where cost accountant finishes, management accountants take over. What the management accountants do? Management accountants do analyze the data which cost accountants provide. They position and present the data in correlation with physical and quantitative data, and they facilitate the managerial process of strategy formulation, decision making, and implementing the decision. Let me give an example. Suppose we have a marketing department, we have social media advertisement, we have television media advertisement, and we have physical newspaper advertisement. Of course, due to COVID-19 in Bombay, at least we are not receiving any physical newspaper. So suppose we are launching a new product, and either a customer has come to our website for e-commerce buying, or a customer has come to our shop or gone to one of our franchisees shop. Then while billing, we ask him where from you came to know. This guy says that I came to know from television advertisement, or I saw this in Facebook sideline advertisement, or I saw in LinkedIn advertisement, etc., etc. So what do we do? When we capture this information, customer vis-a-vis the billing value, vis-a-vis the source from our customer has come to know our product. Essentially, when 1 month's data we analyze, we come to know how many customers we got through social media advertisements, how many we got to physical, or how many we got to television advertisement. And this data presentation of customer number, source of information to the customer about a product, value of amount billed. This data, when we collect, present, and interpret, the marketing manager and the CEO is in a position to decide which is the most effective media of advertisement. So that's the job of management accounting. After identification, ascertainment, allocation, apportionment, assignment of cost, this management accountants does the job of presenting the data, interpreting the data in such a manner that managerial decisions are possible to be taken based on the data presented. So essentially, what is the objectives we are trying to play out here? The objective we are trying to play out is that we are trying to get competitive advantages out of all our activities. By the word competitive advantage, we mean to say that we have to attain cost leadership, we have to attain quality leadership, we have to attain the speed of supply chain management, and we have to be flexible, and we have to be reachable, we have to be accessible to our customer. If all these things are achieved, our product or will be the darling of the mass, we will be the darling of the mass, we will be the preferred supplier of our products to our customer. May it be an industrial customer, or may it be a front end customer, like the ultimate customer of our product. So management accounting helps management to attain competitive advantage. Let me switch over to the next slide. Just to give you a fundamental knowledge about cost and costing. When I say what is cost, we have a very common understanding, means cost is equal to the money I spend. Not necessarily cost is equal to the money I spend. Whenever you spend any money, suppose when you are getting moved by the pain of a man on the street, when you give him a 10 rupee note, you are spending money, but in return you are not getting anything which is economically valuable or can be measured in terms of money. This 10 rupees which you have spent cannot be considered as a cost in costing terminology. So costing terminology gives cost as a very interesting definition. It says the value of any kind sacrificed to create a product, service, or another value. Value of any kind sacrificed. Suppose you go to Google and say that, hey, I'm Apple. Your 10 managers want to buy Google. Okay, I will give 10 Google phones, which are 70,000 rupees per phone. So I give you 7 lakh of rupees. I am sacrificing 7 lakh of rupees. You in turn do not pay me. You give me 7 lakhs worth of advertisement in your various Google websites. So what happened essentially? Though they may not go because they are competitors, but essentially what I'm trying to say is that when you are sacrificing the value of a Google Apple phone, this Google is also sacrificing the value of the space of advertisement which otherwise they would have given to somebody else. They are 2 inch by 2 inch or 3 inch by 3 inch digital space for 1 month in their website. Instead of giving to anybody else, they are giving to Apple. So Apple is giving them 7 phones, and they are giving they Google is giving 7 lakhs worth of advertisement free. So here is a sacrifice taking place both sides. Here is a gain taking place both sides. So both sides has a cost, both sides has a gain. So the definition comes to the value of any kind sacrifice to create a product, service, or another value. So for Apple, the value created is the advertisement. For Google, the value created is the phone given to Google as a company. So that's something is the definition. When you buy a material for manufacturing certain goods, so you have sacrificed a lakh of rupees worth of value from your bank account, and in turn you have got certain product or you have got certain service. Or when you appoint an external maintenance engineer, the value you sacrifice is his maintenance fee, and the service you get is his maintenance service. So that's the definition of cost. Then what is the definition of costing? Costing and cost, there is a difference. Cost is cost as I defined to you. Costing refers to the technique and process of ascertaining cost. As you know, when you manufacture a product, there is it's not that one item only. You spend only one item for one item and you produce the product. 20, 30, 100, 200 different things had to be done to produce a product. And all those items are to be collated in terms of the cost of those items. And after collation only, you are in a position to find the product cost. So costing is a technique, a process for ascertaining cost, and it is also methods used for and the actual process for finding cost. So costing is a technique, costing can be a method also. What is method? Suppose when you go to a refinery from one side, crude oil gets inserted, and from the other side, in series, certain product comes. In first stage comes coal tar, second stage say come diesel, third stage say come petrol, fourth stage comes aviation turbine fuel, fifth stage come kerosene. That way, for fuels keeps on coming, and in different stages you get LPGs, etc. So at when a continuous process of manufacturing keeps on working, you apply a particular process of allocating those costs to different products. So when I refer the word costing, we mean costing is a technique and process of ascertaining cost, methods used, and the actual process of finding cost. We do not apply the same method for finding cost of two different products. Like suppose we are manufacturing cars, we'll be applying manufacturing method, that means job costing method. Or you must have seen the batch number in case of medicine companies. Every medicine has a batch number. Say 1 million hydroxychloroquine is being produced. So this particular method we follow is the job costing, where we give a job number for 1 lakh hydroxychloroquine tablet, and we put all costs together to produce those items. So that's called batch costing. But in case of refinery, it will be process costing. So costing is a technique and a process for ascertaining cost, methods used, and the actual process of finding cost. So when we do apply technique, we apply certain methods also to find those costs. The technique of costing involves two fundamental steps. The first fundamental step is collection and classification of expense according to the cost elements. What are the cost elements? Material cost is a cost element, labor cost is a cost element, then utilities, power, fuel, uh, hot air, or steam. These are utilities. These are different cost elements. Then you have production overhead. That means electricity, lighting. Then you have machine depreciation. These are various production elements, cost elements. So what costing does? Costing collects expense, classifies them according to the cost elements. I'll show you a cost sheet. You will come to know what are those cost elements. Then certain costs are common cost. So costing is a technique which allocates those common cost, allocates, apportions, and assign. Suppose a factory has got 4 different production lines producing 4 different products, and there is a maintenance gang, and that maintenance gang services for maintenance on all the 4 production lines for 4 different products. This maintenance gang's cost has to be allocated to 4 different product lines. So we have to do apportionment. We have a research and development department. We have a factory accounts department, factory at HR department. Those are common expenses for those. So we have to allocate those costs. And we have a headquarter. The headquarter runs 20 such factories. They gives us assign such certain cost. We have to pick up that cost from head office and assign to our products again. So costing techniques are used for allocation, apportionment, assignment of common expenses. Now, when you do costing, you do costing according to certain methods. The method is called cost center as a method. Like I said, in a plastic molding factory, one uh, 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 one particular line produces chairs, one particular line produces buckets, one particular line produces certain kitchen items. So if you have to do the costing of the products produced by these 3 lines, essentially you have to collect all costs which are incurred by these 3 lines. So when we do collection of cost from financial accounting, we do collect according to certain center, and these centers are called the identified center, where a specified type of activity is run, and that identified center is called cost center. A cost center need not be a production place only. It can be a non-production place also. Like, I'm talking about a maintenance gang. A maintenance gang is also a cost center where mechanical maintenance, electrical maintenance, electronic maintenance, civil maintenance, all these peoples are together. All expenses are collected according to civil maintenance group, mechanical group, electrical group, and electronic group. Now, whenever these 4 lines of our production call for their services, their cost is allocated on certain basis, say hours of services rendered. So what we do in a cost center, we collect the cost of running a certain activity. That activity can be a production activity, that activity can be a service activity, that activity can be an administration activity like chairman's office. That is also a cost center, but that is a cost center at the corporate level. Similarly, maintenance gang is also a cost center, but is a cost center at the factory level. Okay, now cost center leads us to profit center. What is a profit center? A profit center is a cluster of activities around which all earnings and expenses are collected and collated for ascertaining profit earned. What is this cluster of activities? Let us understand that the same plastic molding factory produces buckets, kitchenware, chairs, and other items. Now, we can say that entire factory is a profit center, but management would be interested to know how much profit I earn from bucket, how much profit I may earn from making plastic furniture like chairs, how much from kitchenware, and how much for other items. So we have to necessarily, as a cost accountant, develop a profit center and collect all the sales and cost of bucket separately, kitchenware separately, furniture unit separately. So bucket unit is a profit center. Furniture unit is a profit center. So if within furniture unit there can be more than one cost center also, like materials department is a cost center for furniture unit, or the furniture molding, injection molding, then final finishing could be a cost center. Similarly, within the factory, there is another cost center which give common services like maintenance gang. So all these common cost and direct cost are allocated according to the profit center understanding, and then the profit of each center is developed. Can a cost center be a profit center? Answer is yes. Example, plastic molding for furniture production is a cost center, and at the higher level it's a profit center. But is maintenance gang a profit center? No. Maintenance gang doesn't sell anything outside, so it doesn't any revenue for the company. So a profit center earns revenue and incurs expense. At the end, it earns profit. So, so when we do costing, we do according to our activity. And when we do costing according to activity, we call it activity-based costing. Like, let's example, I'm doing plastic molding factory production. Now, in the morning, I am producing a, a chair for children, and in the afternoon, I'll be producing plastic chairs for seniors, well, bigger size chair for senior people. Now, the molding dies, etc., have to be set, machine has to be set in a precise manner, the temperature control, the injection of plastic globules, etc., are to be controlled. Once these setup of the machines are done, then the production labor comes and start producing. So this setting up is not a production activity. Setting up is a setting up activity. So at times we do costing according to setting up. Suppose the same the setting up group is not only for plastic molding of chair. The same setting up groups for kitchenware molding. Kitchenware items. So this setting up group is a cost center or an activity. Suppose their total per hour cost is determined. If 4 people worked for setting up machines, what is their per hour cost for setting up? So when I say I am doing costing based on activity, I am doing a costing based on the activity which is generating certain results or generating certain actions. Similarly, when the production starts, the labor is conducting production. So production is also an activity. So we started with machine setup activity, then we are doing production activity. Then after the production is done, there will be quality inspection, that is an activity. After quality inspection, there will be a packaging, that's an activity. So when we do find cost according to activity, it is called activity-based costing. Now, what is a critical factor activity? The critical factor is that each activity is an economic event that causes exchange of value. Anything happening in a corporate organization or a commercial organization, mind you, doesn't happen free of cost. So cost accountants is very keen and anxious to know every single activity cost based on cost center, profit center, because at the end of the day, he has to provide information to management which will help them to find the price of the product, help them to find the profit of the activity, help them to find where they are going wrong, why their cost is more than the cost of the competitor, etc., etc. So a particular cost accountant is very, very keen and cautious to understand the cost at every primary point where the cost is being incurred, either according to activity or according to certain center or according to certain cluster and according to certain driver. A physical object or a subjective aspect is a cost driver. Example of a cost driver. Suppose a particular molding machine is gets heated up very soon. So you have to continuously pass on coolant liquid in a very, very careful manner so that after every pressing, the coolant material passes through the die and reduces its temperature. Suppose in kitchenware, this is not required, but in bucket making, because it's a thick plastic, it is required. So in the bucket making, the cost you incurred for cooling the die after every impression, in one impression, suppose it is making 10 buckets. In one press, it is making 10 buckets. After 10 buckets, you are doing the cooling of the die. So this cooling is any process in a manufacturing operation is an expensive process. High, it could be high expense or low expense, that doesn't matter, but there is a cost behind it. So this particular additional activity for the plastic molding buckets, a cost accountant needs to understand what is the additional extra cost which is driven by the cooling activity. So any activity in an operation drives your cost. Okay, next comes the point value chain analysis for optimization uh, of customers' value. Now, when a startup, let's come up that you are thinking of producing a product, or you are thinking of producing a software, or you are thinking of giving a service to an organization or service to something against which you will charge money. What is the process goes? The first thing is research and development. You try to find out through your research and through your process of trial and error, that is called the development process, the product you want to produce. So you do your research and development. Then you, after you research and think of doing what is to be done, then you design of produces and processes. Suppose now vaccine for hydroxychloroquine, let's take that example. Hydroxychloroquine is being given for treatment. But if we can find a vaccine, then this vaccine can immune a person, so this COVID-19 will never attack us. So that's the work going on. So that's at the research and development stage. After that, what will happen? Now the vaccine, you need 2 ml or 1 ml, or you need how the vaccine, whether it is to be kept in cool condition like the vaccine of polio or etc. So after the vaccine is found out, it has to be designed for 2 things. The product has to be designed in terms of packaging and producing. The process has to be designed, how it has to be production has to be done, and after production, how it is to be delivered. Is it to be delivered in a temperature control condition, or it can be delivered just like that, any other injection? So you design the process and the procedure. Then you get into production. That may not be a very big thing because many vaccines are produced. Only thing you need to understand which is the chemicals you have to put in, at what control temperature, how much time you have to produce. So you all decide all parameters of production. Then you decide your marketing plan. Of course, for vaccine, people will be waiting at your doors for market buying, but not all products can be a pre-required product. You have to produce and you have to market also. Suppose you're producing a new product which nobody knows, so you have to market that product. So there is an expense for that. Then you have to, after you market the product, you have collected order, then you have to reach it to the buyer. That is called distribution, selling and distribution. And finally, if the buyer needs certain services after buying your product, you have to deliver the services. So this is the entire value chain of the life cycle of a product. You do research and development, then you design the procedures and produces, then you actually do the production, then you do marketing, then you do distribution, and finally you do customer service and allocation. So essentially these are your jobs. These are the 6 jobs. And your support jobs are supply chain, that is people who help to move your materials and move your finished goods. Your accounting and reporting, that is you yourself, that is the cost accountant or financial accountant. And then you have your other support services like HR, legal, taxation department, etc., etc., etc. So essentially, uh, a cost accountant has to, or a management accountant has to be very careful in understanding the value chain. If you do not understand the value chain properly, you will not be able to do the cost collection properly. So you can see the picture in a blue box here. You can see 4 words: quality, speed, efficiency, cost. A cost accountant or a management accountant has to be cerebral thinker. What is his thinking? His quality has to be good, better in the market, perhaps the best in the market. His speed has to be before any competitor delivers, you have to deliver. And finally, you have to keep on increasing the efficiency of production and efficiency of services. And all these good things you do for quality improvement, speed improvement, and efficiency improvement, the cost has to come down. So it's a two-way sword. One side you have to do everything good. The other side you have to keep watching your cost, because market will not pay you more than what the market wants to pay you. So cost reduction simultaneously with quality, speed, and efficiency improvement, that's the challenge. So when you have to do a challenge, when you have to meet a challenge, you have to take certain decision. How can you take a decision? Suppose if financial accountant gives you a trial balance and says that give me the cost of this product, because I have a factory of 4 product types of products. Within those products also there are different sizes. You give me from this trial balance, you give me the profit of each type of my product. You'll be completely at loss. You will not be able to do. So what do you have to do? You have to do certain classification of cost. So the costing tool, the applied for classification of cost, is essentially for decision making, because essentially for controlling your cost. Because suppose you produce a product and your price of that product is 100, and you find that your material cost of of that same product is 45. When you compare yourself with the best in the industry, based on data you gather, you find that their cost is 35 and your cost is 45. Product is the same. What is the issue? So essentially, if you are not in a position to break up your cost according to the elements, you are not in a position to take a management decision whether you are going in the right direction, which of the elements of cost is more expensive in your product. Is it the material? Is it the labor? Is it the operations cost? Here operations cost means factory operation, manufacturing operation, or marketing operation, which are directly connected, which are expensive. Administration overhead, that is your HR, marketing, taxation, legal, etc. And marketing, selling, and distribution. So when you do financial accounting, uh, the trial balance is distributed according to the traditional classification of the nature of cost. Again, a cost accountant also does classification of cost according to their behavior. Certain cost you incur on a monthly basis, and certain cost you incur uh, on a product basis. I give you an example. When you appoint a production supervisor, you give him a monthly salary. But suppose in the same factory, you appoint labor who are piece rate producer. That means if you produce 1,000 units, you get this much of money. If you get so if for up to 1,000 rate, there is a particular piece rate. After, if you produce 1,200, after 1,000 you get certain incentive. So for producing, there is another rate of variable rate. So certain rates which do not change with your change in quantity of activity is called fixed cost, that is based on period. It doesn't change with volume of activity, it's change with the period of activity. That is monthly cost, like monthly salary of the HR manager. Certain costs are variable cost. With every single additional unit produced, the cost increases. So that's called a variable cost. Certain costs are semi-variable cost or semi-fixed cost. For example, which is a semi-variable cost and which is a semi-fixed cost? Semi-variable cost is a cost. Suppose you have a factory in which you have space. Okay, so as of now, you are producing 800 pieces of labor, pieces of a particular product, and for every unit up to 800 piece, the cost varies. Certain expenses varies, but certain expenses also remain fixed. Suppose you decide that one of the machines, if I change, then the production quantity will suddenly increase from 800 to 1,200. So it's a bottleneck machine. So what I do, I add the cost of that, and now I increase my production to 800 to 1,200. So items which were fixed up to a certain stage suddenly got a jump by adding certain machines, and again it got fixed at 1,200. So what is a semi-fixed expenses? A semi-fixed expenses is the expenses which remain fixed up to a particular volume of activity. After that, it increases and again stables at a particular level, remains stable up to a certain level. After the level is crossed, it again increases. So this is called semi-variable expenses or semi-fixed expenses. What is a one-off cost? One-off cost is a cost which is incurred only for once. For example, God forbid you have a fire, small fire in your factory. So the maintenance expense you incur to bring back the area which got fire to a normal working condition after all kinds of maintenance, etc. This cost will never be incurred, neither as a fixed cost nor as a variable cost. So this cost is called one-off cost. That means a cost which never gets incurred twice. Then degree of traceability, direct cost and indirect cost. For example, you are wearing a shirt. In that shirt, you can see the material, clothing material by which the shirt has been made. You can see the stitching threads, you can see the buttons, and you can see the stiffener of the collar. So all these items can be directly traced in the product. But let me give you a very stupid example. This shirt, after being stitched by the guy, by the tailor or the machine, whatever it is, the process, it didn't come to you directly. Somebody washed it. It was put through a process. It got washed. Then it was put through a process. It got ironed, properly folded, packed up in a material, then came to you via a shop. So what is that in degree of traceable? Which costs are not traceable when the shirt came to your hand? That ironing cost was not traceable. Washing cost was not traceable. The packing is traceable, but the guy who packed it, his salary is not traceable. So items which are traceable in your finished product is called direct cost, and items which are not traceable, it's called indirect cost. Uh, Direct cost and indirect cost has got another definition. Example, labor who are working in that plastic molding factory for 4 different departments. For chair department, labor cost per chair is the direct cost. For kitchenware department, labor cost per kitchenware is the direct cost. But for maintenance gang, it's an indirect cost. It is not directly connected. Why do we apply this? We apply this because why do we do these classifications? We do classification because going forward, this information would be required. Like I will show you why this information will be required in going forward. So on the right hand side, you can see a picture. So basis of cost classification is nature, relation to cost center, function, behavior, management decision making, production process, and time. Uh, suppose that same dispensary in the factory, the example I gave you, it is a salary, but we call it a function of welfare or medical service function. So we do classification of certain expenses which are strictly related to that dispensary according to the function of medical service or staff welfare. So when we do a variable and fixed, we call it behavior. When you do management decision making, that means that is people who take management decision, their cost is finally allocated to you. That is the management decision making cost. But at times management tells you that these are the expenses at the moment. Suppose I am giving a 20% discount at the moment because I am launching a new product in the market. So essentially this 20% discount, my product price is 100 and I am selling it at 80. Essentially, this 20 rupees which I am not collecting, management considers it as a cost because my competitor sells it at 100. So it is an 100 rupees. Price is 100. I am essentially sacrificing 20 rupees by way of discount. So management may tell you, okay, financial accountants will take 80 rupees as turnover, but as a cost accountant, for me to help my decision making, you consider 100 as the price and 20 as your discount. Going forward, we will see the sensitivity of the market. When you reduce our discount to 15%, we'll see how much our sale falls. So this data you collect for behavior of the market, sensitivity of the market in correlation to our pricing. Suppose if you would have not collected this discount data separately and you have booked your sales directly at 80 rupees or 85 rupees, your data would have been lost and you would have not been in a position to help your management. So certain cost classification is done according to the management decision need. Again, production process, like I gave you the example of a refinery. Up to the stage of diesel, there will be one kind of production process. After diesel, when it goes to LPG making, the gas which gets thrown out from the processing system gets captured and liquefied by pressure and sent through a bottling plant to you as a cylinder gas. So the production process helps you to do the classification, and time also helps you to do classification. Like example, certain costs are recovered through 10 years. The machine which you buy, you use it for 10 years. So the time period is not 1 year, time period is 10 years. So the depreciation which you charge, the depreciation which charge, that depreciation is a 1 year charge. That is the year's charge. But the capital item which you buy, it's a 10 years cost. So which you allocate for 10 years because the life of the machine is 10 years. So When I say direct cost, it's if it is associated with the product directly, I call it direct. Otherwise, I call it indirect. Why this classification is done for direct indirect? What is the benefit of decision? Suppose I, as a maintenance manager, I'm the head of the department of maintenance. If I am not allowed to see, or I am not in a position to see what is the total cost of my maintenance department, how I will be able to control my cost? So one of the costing method, or the way of allocation cost and way of collecting cost, the objective behind this madness of so many classification of cost is to facilitate the process of controlling and monitoring. Then we can do functional classification of cost: manufacturing cost, administrative cost, marketing cost, selling and distribution cost. According to the function, we do manufacturing. Within manufacturing cost, there may be many other different types of cost, like material cost, labor cost, power and fuel cost, machine overhead cost, electricity, then maintenance gangs cost, etc. Administrative cost within a printing and stationery, computer software, people's cost, then say air conditioning of the office rent. So there are plenty. I need not get into that much of detail. When you say relationship with accounting period, I just gave example of the capital cost. And what is the revenue cost? Revenue cost is the cost whose effect goes away in the time period by which it is spent. Like salary. Salary is a revenue cost. But capital cost is not a revenue cost. Capital cost gives you benefit for more than one calendar year. According to the nature of control, certain cost classifications are done. Certain costs are controllable, certain costs are not controllable. Example, salary is a controllable cost. You can decide how much salary you will pay. But let's give an example of TCS versus Infosys. A graduate engineer, if he is hired, best graduate engineer, if he is hired, suppose TCS pays, let's for assumption, just a number, 40,000 rupees per month. Can Infosys hire 20,000 rupees? The same category, same quality of people? Answer is no. He has to essentially share hire at a market price. So here, this particular cost is not a controllable cost, because market determines the price of a good graduate engineer. But when it comes to the company, how much space he will be provided, what kind of facility he will be provided, what kind of comfort he will be provided. In company X, you can work in a 60 square feet area, that could be your space area, workstation area. In another company, it could be 100 square feet. Between these two companies, 100 square feet space area will be definitely a higher cost office for you to use that, occupy that space. So for this company, space given to you for working in your office is a controllable cost, but your salary may not be controllable. What is the standard cost? Standard cost are cost which management decides that this is the cost within which I have to keep my expenses restricted. Management decide that ideal condition, this should be the cost for doing a job. That's the standard cost. What is the budgeted cost? Ideal cannot be achieved always. So management decides, okay, let me do a piling up of the cost. Let me do a proper assessment. Management decides a proper assessment and budgets a cost. And that's a budgetary cost. Budgetary cost could be standard cost also, but difference between standard and budget is standard is ideal, budget is practical. So look at the picture, cost management, four primary phases. So first you do cost management, you first do a resource planning, then you do cost estimating, then you do cost budgeting, and then you do cost control. So essentially what you do, if you have to do a particular cost management and keep certain cost according to the ideal situation of standard and budgetary cost, then you cannot say that I will start controlling from tomorrow. No, answer is no. A cost control, if you have to take a decision and apply the methodology of continuously competing at the marketplace with the lowest possible cost, then you have to go 3 steps behind from cost control. First step, your resource planning. You have to go to the drawing board, do a complete resource planning. Here, the resource not only means your capital assets, resource means your material, people, utilities, space, everything. Then you have to do, after resource planning, you have to do an estimation that if I use this resource to produce 1 million unit of a particular product, what is my cost estimate? This cost estimate you do on a very ideal basis, but all ideals cannot be achieved. So what do you go? You do, okay, say first year I'll achieve 90% of the ideal. So my cost will be 110. Next year I'll make it 105. Next year I'll do 100. Next year I'll do 95. So you go through the process of cost budgeting and controlling, and the cycle goes back, and gradually you come from 110 to 95 and 90. So that's the process. If you have to go through the process of ultimately becoming a competitive cost man, or if your product has to be lowest cost item in the industry, you have to go through this process of classification of cost according to the need of management for making decision. That's the beauty of cost accounting, is that the costing techniques and costing processes are helping hand for people and business manager to take decisions. Okay, so that's what I was explaining to you. First, look at the picture. In the picture, you first decide what is the product requirement of the market. Then you design the product. Then you design the process, that if this is the product, this is the process to produce the product. Could be a service also. And then it could be an entertainment service, a cinema. A cinema, you have to produce the cinema, then only, or you a TV serial. You have to produce the serial, then only you can stream it down. Or suppose you are doing a software designing. That's a service you are giving. Or you are doing a software implementation. You have to design the process by which you implement the software. Then only you will be able to do. Now suppose you want to suppose you want to do a product in which there are 10 different components. You may decide to make 3 major components and 7 minor components you may buy. Whether you will make it within or buy it from outside, how you'll be determining? You'll be determining by make or buy decision. Again, there is a costing needed. If you produce the good within the factory, what is the cost? And if you buy the same product from outside of the same quality, what is the cost? Again, suppose you were so long producing a particular component, and from tomorrow you decide that no, I don't want to produce that component. I want to buy it. Suppose you depend only upon one manufacturer. After 3 months, this manufacturer says that I will not be giving you that item. So again, you cannot go back to production because you have already stopped. So essentially what you will do, you will develop 2-3 sources from which you will buy the component. So again, these 3 sources may not be giving you at the same price. So your cost may be a little more. So essentially, if you have to take a decision of making a component or buying a component, again, you have to get into the costing of the component. If you make the component within the factory, what is your cost? If you have to buy the component, what is the procurement cost? Complete cost up to the point of use at the factory, what is the cost? And then you take a decision which is the better. So you have to essentially do a supplier cost estimate. Suppose cost is too high, you are finding that whether your supplier gives it or you produce it, the cost is becoming too high. It does shows that there is a difficulty in your product design. The difficulty of product design could be the design itself, or it could be that the raw material which you are using, you could have used some other raw material, or you could have designed the product a little differently. So again, you go back to the drawing board. So here the point is, the picture shows that costing is not a one-time item. because at the marketplace, day by day, competitors are coming and offering goods and services at a lower cost than what it was earlier. You have to continuously be on the toes and continuously keep feeding management for cost, and give them costs which are available. Continuously benchmark your cost with your competitors cost or based in the industry cost. Then only you will be able to make people understand through your costing services that which is the ideal situation about the company. So when you do that, for planning and decision making, when you do cost, you have to do certain other categorization of cost. You have so far seen these few categorization of cost according to tradition, behavior, degree of traceability, association with the product, functional classification, relationship with accounting period, and control. But here is another set of items. What is the outlay cost? Outlay cost is a cost which is essentially cost for implementing a strategy or buying a capital asset. Suppose a plant is producing very well, but suddenly the producer finds that his competitor has put up another machine which improves the quality of the product in terms of look and feel, or in terms of its life, or in terms of the ease of the customer, whatever it is. The quality of the product is good. Like you have seen a television. Earlier, you couldn't see your, suppose you are seeing a film in the camera, and so quickly you switch it over. Sorry, you are seeing a film on your on your handset mobile phone, and now a television is available, which is a smart television. You can push this handset picture to the television, and you can see through a bigger screen. So essentially, what happened? Certain improvement has taken. So your business, your product guy has taken a decision that I want to buy produce a smart TV. So it's his business strategy of producing a smart TV at a higher cost. So the additional capex you incurred for producing that smart TV, or adding equipment to produce those components which will be converting your normal TV to a smart TV, is an outlay cost. What is an opportunity cost? Opportunity cost is like this. Suppose you are producing certain electronic component. Suppose you can produce A, B, C, and D, 4 types of electronic components with the facility in your factory. You can, you are finding that A, B, C you will be producing, D you will not be producing now, because D, if you 1 hour run the factory, you produce 100 units of D. 100 units of D gives you 500 rupees of profit. In the same 1 hour, you can produce 150 units of C, and it gives you 4 rupees per unit profit. So you can make 600 rupees profit. So better to use it for C and not to use it for D, because ultimately your opportunity cost of not producing C is 100 rupees. How? If you produce D, you earn 500. If you produce the same factory, if you produce item C, you get 600 rupees profit. So by producing D, you will be sacrificing a profit of 100. 100 here is 600 minus 500. So your opportunity cost of not producing C is 100. That means whatever you sacrifice by taking decision A instead of decision B is called opportunity cost. Then sunk cost. Sunk cost means money which you have spent and cannot be recovered back. Suppose you thought you will be producing certain product, and you have bought 3 machines which produces the product. After 2-3 years, the product is no longer in demand because certain other product has come which is much superior, and that those other products you cannot produce your existing machine. So within 3 years, you could not recover the full cost of the machine. So whatever WDV remained of that machine is called the sunk cost here. Then the relevant cost. Certain cost which are needed for decision making is called the relevant cost. Example, suppose the kitchen equipment, kitchenware making, in that injection molding example, kitchenware making laborer needs much more skill than the bucket making, because kitchenwares are all critical items. So whenever you are taking the costing decisions for the kitchenware unit, you need only kitchenware related cost only, not the bucket related cost. What is the per hour labor cost or per day labor cost of the bucket unit? You don't need that. That is not the relevant for you. The relevant for you are the cost which you incur for your kitchenware plant or kitchenware line of production. So relevant cost is that cost which is required for taking a relevant decision. And next is the differential cost. At times, we take orders in bulk. So we produce in bulk and we sell in bulk. Suppose at the moment I'm producing 150 tons of product in a month in my factory. I got a bulk order of producing another 30 tons in a year, means 2.5 tons per annum, because a product, one order has come. So certain costs are variable, of course, I understand, but certain additional expenses I have to incur, which some of which are fixed nature, some of which are of one-off nature, some of which you have to incur for producing the item. So some new dies, etc., had to be incurred, etc. So what you do a total cost. Total cost of producing 150 tons and total cost of producing 180 tons. The difference between the two total cost is called the differential cost. That means differential cost of running the plant at a particular level versus the cost in additional cost incurred for running the plant at a particular level. This is called the differential cost. Next is the imputed cost. Certain costs are not at all incurred, but those costs are forcefully imputed into a product. For example, suppose I produce certain product which can work at a particular. Suppose I'm producing a grease or lubricating oil. This grease and lubricating oil can function in every machine. But if the machine generates a temperature of more than 300 degree while it runs, the grease melts. So what I do, I run an R&D factory, R&D center in my plant, where I try to find out that my existing greases, how it can function at 500 degree temperature, or how it can function in sub-zero condition, like in Leh Ladakh, where machines are run in sub-zero condition, the grease doesn't get completely frozen. So till such time I run this R&D and my new product is found, and my R&D cost is not recovered through my existing product, I will not be able to make profit, because R&D cost is high. So what I do, even if I am not producing those type of specialty greases, this existing R&D cost, I get it imputed into my existing product forcefully. Though existing product doesn't require this particular R&D, even then I do it. That is called imputed cost. Then out-of-pocket cost. Out-of-pocket cost is called discretionary cost, which management does it out of goodwill. Suppose you are making coffee, and you are launching a new type of coffee, and you are giving say dairy milk, 100 gram or 200 gram additional dairy milk you are packing up along with your coffee. You are not charging them extra. So this cost which you are incurring to pack up the additional 100 or 200 grams of dairy milk along with your coffee packet, it is called the discretionary or out-of-pocket expenses. Shutdown cost. management needs for this shutdown cost, because uh, suppose a factory doesn't have any order, or whatever order it is there, the factory is running, the factory is losing proposition instead of producing. When you know that if I keep the factory 1 month closed, I will make much losses. But after 1 year, 1 month or 2 months, when I come back, then I will be able to produce more. So what you are doing, if you are, when you do this plant keep under shutdown, you incur certain expenses like security, maintenance, etc. So those expenses you calculate and place it before management to take a decision whether it will be good to go for shutdown to incur those expenses, or well good to go for a lower capacity production, whatever little money you earn, continue to earn. So shutdown cost is the cost which you incur when a plant is under shutdown. Joint cost, what is a joint cost? A cost which you incur for producing two products simultaneously. You are producing out of lubricant, out of crude oil, uh, diesel, then kerosene, then petrol, then LPG. The crude cost or the first set of processing cost is the joint cost. Common cost, certain costs are incurred for common for two products or three products. I like give you the injection molding, that's called common cost. What is the target cost? That's a very important cost for decision making. Suppose I want to buy, I'm producing a product in which I need 6 components, and 4 components I don't want to produce anymore because I want to keep my factory free because I have another new product to produce in that. So what I decide that 4 components I want to give it to certain ancillaries. Now, when I want to buy those products from outside, I do a targeting. And if I can get vendors at this target cost, then only I buy. So I will be setting a target cost for buying it. When you set a cost, which is the cost at which you want to buy a product or a service, that is called your target cost. Let's move on. This is the typical cost sheet of a product which I was talking to you. When you do all direct expenses clubbing, you call it prime cost. After that, you add your indirect expenses like depreciation of plant and machinery, factory overhead, repairs, factory staff salary, other indirect expenses, which people do not participate directly into the process, but those are definitely required. So that's called indirect expenses. When you add, it's called cost of production. Then these are all production related indirect cost. Now you add certain administration overhead, like office expenses, like legal, environment, health and safety expenses, like factory gardening, because 25% of any factory has to be a green zone as per Government of India regulation these days. So all this taken together is called administration and other expenses. So you get your cost of goods sold. After this cost of goods sold, you add your selling and distribution expenses. Here will be your sales force cost, your freight outward, your advertisement, your marketing, and your other expenses. You add to that, it is your selling and distribution expenses. And finally, you have a head office, you have other small expenses, could be head office expense to one, could be your legal department expense, or could be you have a foreign office which you maintain for procurement of orders, so foreign office expenses, etc., etc. So all this taken together, when you finally add these two, you get the cost of sales. Beyond this cost of sales, you don't have any other cost. When you deduct your sale price, which is there on top, you get your profit. Now, why this necessary? Why this is necessary? You can see the columns which I've added: budget actual variance, say April and May. When you start a year, you do certain budgeting of your product cost. Then you do actually run a month. After the running a month, you plot these numbers against the budget. What is the purpose of doing this? Purpose of doing this is to find where I'm going wrong. That's the variance. So this presentation helps management to take a corrective decision. Wherever I am going wrong, why I am going wrong, what I am doing differently which the competitors are not doing. Am I incurring certain additional expenses which I can avoid? Or is there any other way of doing the work? Is it that my procurement of material cost is high? Suppose you would have had one number called cost of sales, you would have not been in a position to do all these analysis. Now that you have allocated the cost according to their stages and according to their nature, you are in a position to find out the cost according to the stages. And now you are in a position to better identify that particular small area where you have to take corrective action. Suppose in certain item you find that whatever you have budgeted, your actual cost has come even 40% less than that. Or that means there is something wrong in your budgeting, or something has happened in the marketplace for which your procurement cost has come down, or you are doing managing better. So if you or it could be a real sense of success, you have taken certain decisions which has given you certain benefits, so you get an encouragement. So this particular tool, cost sheet, is a tool for pricing, and it's a tool for controlling cost. Now I will go a bit fast, because now we have created the base, and now we can discuss quite fast. Certain expenses of fixed, we have fixed as an expenses we have not discussed much. Let's discuss the fixed expenses little better. Fixed expenses are generally of certain nature. One is a programmed cost, like R&D cost. I gave you the example that I am producing greases and lubricating oil for 300 degree Celsius temperature, but I'm conducting R&D to make my greases work at 500-degree temperature. So that's a programmed cost, because my management has taken a program to run this R&D. So this R&D is a program cost. Exclusively period related cost, salary of employees. Suppose I find, why I need to understand this. Suppose I find that my product is seasonal, so I need certain kind of services during the season only, for which I appoint people throughout the year. So if I can identify which are the services and who are the people, I can tell them, okay, we will now onwards appoint you on a seasonal basis, and for rest of this out of season period, you find out a job for yourself. Or I will transfer you to so and so country. You will or so and so zone, or I will transfer you from so and so functional area to so and so functional area. So what essentially you are doing? You are essentially trying to understand that the person whom I have appointed, am I in a position to gainfully appoint him for the period for which I am incurring his salary cost. So when you are having an exclusively period oriented cost, you have to essentially analyze through your decision making process whether your period ending cost is really generating the value which is supposed to generate, or you are giving the person cost for idle time. So idle time identification helps you. Certain expenses are discretionary expenses. Suppose you want to launch your product. Suppose you want to launch your product and you want to go for a trade fair. So that expense of yours is a discretionary expense, so that you will go for trade fair or not, discretion. Like the coffee ke saath, you are trying to give certain milk. Change within fixed period but not significantly. Like suppose you are due to COVID-19, workers are supposed to work 12 hours. After COVID-19, it is decided in some of the states that 12-hour working will be done. So there will be an extra shift money. So workers may be paid 4 hours extra. So the period remaining same, that is the month, but extra salary is being paid because of the extra time. So that's called fixed period, but not significantly increasing. Next is sudden cost or committed cost, like you give donation, that's a committed cost. You give training to your employees, that's it, committed cost. So certain fixed cost can be programmed, period, discretionary, changed with the period, and the committed. So why do you need to do this classification? You need to do this classification of fixed cost in order to take a decision whether these are essential requirements, where I can do control, etc., etc. Let's go to the next slide. This is a very important point, which is semi-variable expenses. And semi-variable, we explained to you. You can, from this slide, you can get into the picture. You can get an idea whatever variable cost. You can see variable cost line is following that this blue line is doing a 45-degree angle. That means every time the number of units are increasing, the cost is also increasing in the same proportion. But up to this unit, the fixed cost is remaining same. So variable cost increases with every single unit in cost of production, in production or quantity. Like raw material, every single unit you produce, you need every single unit equivalent of raw material. Labor, electricity consumption. These are some of the, or commission on sales to your distributors. Every single unit you sell, you give commission to your distributor. So these expenses which increase with every single unit increase or decrease, it called a variable cost. And cost which do not change, remain fixed for a period, it's called a fixed cost. So departmentalization of overhead, this I have covered quite a lot during my talk. Essentially, one thing here you must have to understand that whenever as a cost accountant, you do a departmentalization of overhead, like for marketing, HR, legal, accounting, and finance, you do departmentalization of overhead. Only departmentalization of overhead is not sufficient. You as a cost accountant must further collate those data under three categories: essential, avoidable, or controllable. I'll give an example of avoidable. In your washroom, the most important item is water. The next important item is soap. Third important item is the tissue paper. Now, you can do a costing analysis of tissue paper versus a hand dryer. Now, is the tissue paper available? Answer is yes. Tissue paper is available. If you stop providing tissue paper, nothing will happen. You give them a hand dryer, or you can give a circular that the company has taken a decision to go green and not waste any paper item further. So tissue papers will not be available from tomorrow in the washroom. Job is done. You are cutting cost under the grab of going green. And it is also not essential. So water you have to provide, coffee you have to provide, soap you have to provide, but tissue paper may not be required. So you have to essentially understand what is an avoidable cost and what is a controllable cost. All costs, some costs are not available, but those costs are controllable. Like certain people, certain departments remain open after 6:30 and electricity goes running up to 8 o'clock because of one person saying. That one person you can shift to room and switch on the room light only, rest of the office light can be closed except for security requirement. So these are, when you do departmentalization of overhead, keep it in your mind that you are essentially trying to find out which cost is set. Certain departmentalization of overhead is required for valuation of inventory. Inventory is to be valued at the direct production cost. So expenses which are incurred for producing a goods up to this, bringing it to the stage of finished goods, those expenses are to be classified according to department. I'll give you an example. Suppose warehouse, you have uh, you have shifted your materials to warehouse. Now, as per rule of accounting standard, you have to do valuation of goods lying in the warehouse at the cost, which is cost of production uh, and transportation cost from factory to the warehouse, and you have to add to that warehouse overhead also, because you have kept it in the warehouse. You are allowed to do that. So see, departmentalization of overhead for warehouse is necessary because you have to do the valuation of inventory also. So that's very important. At times you have to do the analysis of cost due to certain regulatory requirement. Okay. Uh, Methods of allocating cost, I don't want to get into this because our mandate is for decision. Although I have discussed this a bit earlier in my talking, so I'll skip this slide. Uh, Essentially, this is a very important point which you have to understand, is that what is your guiding principle for pricing a product? The guiding principle should that this is the society is benefiting or getting harmed, and your enterprise is getting benefited or being harmed. So friends, it's a 2 hour session, so I will quickly move over to certain higher level of decision making area. So if the society is benefited and the enterprise is home, then you are making your customer happy at the cost of your loss. Okay. If the society is harmed and the enterprise is also harmed, you are becoming a terrorist. It means neither you are gaining anything, you are selling a product at a very high price. Excuse me.
जी सर।
Yes, Shandip.
सर एक मिनट बात कराता हूँ मैं आपकी।
Excuse me. So essentially, if the society is harmed and the organization is benefited, you are sucking the customer. So you are a parasite. So essentially, what you have to do, whatever product you produce, whatever service you render, you have to ensure that the price which you charge is benefiting the society. Society is getting the value for money. Society means your customer, and you as an enterprise is also earning sufficient profit. So in such a situation, win-win strategy is the main strategy. So one of the most important requirement of cost and management accountants in the decision making process is to understand that whether I'm delivering the value which my customer is paying for. Am I charging extra, or am I charging low, or am I charging which is desirable? Competition is charging low, that's why I'm also charging low, may not be necessarily something which I need to understand. You may be knowing that Apple phone is any day more costly than the Samsung phone, but customers are ready to give that price because customer gets the value for that. So it has to be a win-win strategy. That is the idea here. Yes, Sandeep, you, is it going okay? I have unmuted it. I have unmuted it. Okay, thank you. So this is the guiding principle of any cost accountant, any management accountant, to be a win-win strategist for both yourself and your customer and and stakeholders. Uh, I'm not going to get into the this particular slide. The idea of this slide, when you do your studies, you please try to understand that activity which you do, is that activity essential? Is that activity you are correctly assessing? Suppose you have four departments, so all maintenance department expenses you are dividing by 4 and allocating in that injection molding example. But it could be possible that the bucket making unit is calling people maximum time for maintenance. There is some problem with their machinery, so they are calling maintenance people services maximum. So while you allocate the cost of maintenance department, you should book the cost of maintenance department to bucket making people more. So you have to find out the method by which a particular common cost is allocated to the user of that common cost on certain practical basis, on the basis of actual utilization of the services. You should not get a method applied, take a decision of allocating the cost using a method which is not correct, which does not truly reflect the cost. So always, as a cost accountant, you should be a practical person. That is the point I'm making in this slide. So carefully look at this equation. When you do value creation, your result divided by cost should be more than 1, right? So how can you maximize cost? How can you maximize your value? Here the value means return. So either you increase your utility, cost remains same, your result will be more than 1, or your utility remains same, cost reduces, your result will be more than 1, or you maximize utility and minimize cost, your result will be more than 1. So in ideal situation, a cost accountant should first answer that how do I minimize cost? The way, if I minimize cost by controlling controllable cost, stopping avoidable cost, my revenue earnings remaining the same, my profit increases. So essentially, you have to be very innovative. You have to understand the drivers, strategic drivers of the value. What is the item of manufacturing? What is the activity in my manufacturing operations which actually generates the value? Which actually generates the value? That is most important. You have to create strategy, you have to formulate strategy, develop superior organizational capabilities. That means you have to work towards a situation that your organization understand the external environment better, the organization understands the internal environment better, and thus generates a much better cost accounting and cost allocating principles by which the true facts about the cost and the drivers of cost come out. And wherever the avoidable controllable elements are there, those are truly reflected in your paper, and management is in a position to take a better decision. If at all it comes to like this, that you cannot do improvement beyond a certain point and you continuously bleed, that means you will be continuously operating in loss, then it's better that you stop that operation. Because the money which you have, if you are continuously bleeding, and if there is no chance of going forward after 1 year or 1.5 years or 6 months, that bleeding will stop and you will start earning money, there is absolutely no point. But if you do not reflect the reality picture of the costing and profitability and profit through your actual allocation of cost, actual data finding of cost, you will be doing injustice to the organization. Suppose you are producing 4 products and the third product is bleeding, but because of your wrong cost allocation, you are not in a position to understand that the third product is bleeding, and you are continuously making loss in the third product. You will be doing a great injustice to the organization. So essentially, finding the true cost of a product is the job of a cost accountant. And presenting the same true cost in a convincing manner for managerial decision making is the job of a management accountant. This I discussed already. These are the value chain activities. Uh, what essentially you have to look at is that your activities should be minimum in number. Every activity should be effectively adding value. Every activity should be performed at a lower cost, and every activity should be benchmarked with your competitor at the national and international level. It does mean that at any point of time you have time to rest in peace. In terms of my everything is Ankidori, I did not do anything. You have to continuously keep on working on your cost data. This I have already discussed. This is a Michael Porter. You can study when you are doing your actual courses. Now I'll get into certain decision variables. Now how costing can help decision making. I'll give you certain examples, which I have of course given quite a few examples as I come so far. But let me formalize the discussion quite a bit now. When you take a decision, you essentially do what? I read the quotation: decision making is the process by which managers respond to opportunities and threats by analyzing options and making decision about goals and course of actions. Essentially, you take any decision for 2 things. Either there is an opportunity in front of you, you want to make use of that opportunity and earn profit, or there is a threat in front of you, you respond to that threat and you incur minimum loss. Now, in both the cases, you do 2 things in decision making. First thing you do, you decide what is the goal by taking the decision. That means how much product you want to produce and how much profit you want to make, because the opportunity is there, and how you will do that, what resources you will require. If it is a threat, how you will manage the threat so that you incur minimum possible loss and you incur minimum possible cost to implement your decision. So whenever you take any decision, you take decision about 2 things. One, what is the objective of taking that decision and how the decision will be implemented. And the word how is inclusive of how much cost will be incurred for implementing this decision. So remember, the doing what is right is not hard. Doing what is right is not hard. Everybody can do the right thing in the right way. But what is the right thing to be done? That's the most difficult thing to understand and appreciate. And mind you, once you have made your marks, watch out for the eraser. It means, suppose you have started doing the right thing in the right way, you should not be happy about it, because there are many other businessmen are sitting on the wayside with a lot of money. They will come in the business and they will do a better job than you, and your business will go away. So you will have to be continuously in search of the right thing. So what are your decision variables? How do you take a decision? You take a decision by this process. You determination of the objective of its quantification. Your decision is how much you want to produce, how much you want to make profit. These are all your quantification. Definition of the problem to be resolved or tasks to be accomplished. What exactly you want to do? Suppose you are doing a digital transformation, you are starting an e-commerce platform, you will be spending 1 crore rupees to start that e-commerce platform. You have to set an objective in front of you that by this e-commerce platform, how much percentage of your sales you will be doing through e-commerce platforms. So suppose today you are selling 100 crore product. You have set a target that by third year from today, I'll be shifting 40% of my trading through e-commerce platform, because that will make you save 10% of your sales and distribution cost. And you are doing an equation of how much extra you are spending and how much money will be saved, and you are doing a profit calculation. So all these things you have to do for by way of quantification of your decision variables. And decision variables are: what is your cost of setting up the platform, what is the earnings you will do, how much additional cost you will save, how much additional cost you will incur, and in the process how much it will be your incremental or differential cost and differential earnings. So then you do quantification and measure the subjective elements. Here the subjective element is that you have taken a subjective judgment that 40% of your customer will shift to e-commerce, may it be B2B customer or B2C customer. Now this quantification has got some certain subjective element. You have to essentially find out those subjective elements, how can it be objectively measured. So you have to decide your evaluation process using certain practical course of action. You have to do some research, etc. And you have to take some industry experience, you have to appoint some experts, etc. You have to assess and anticipate the requirements in the reality. And finally, you have to do the decision. So when you do take a decision, the role of a cost and management accountant is to place the actual cost, the differential cost, the marginal cost, the incremental cost, the joint cost, the additional cost, common cost, how to allocate the cost to that particular e-commerce platform. What are the existing costs I'm going to save by 40% shifting of the trade to e-commerce platform? All these things are to be quantified. Then only you are in a position to do analysis. So when you do analysis, keep in mind that what are your direct and indirect cost incurred and cost savings, whether those are relevant. If it is not relevant for this decision, don't consider that. Don't beat about the bush. What are your primary consideration and what are your secondary consideration? Certain benefits will be primary, certain benefits will be secondary benefits, consequential benefits. You can say that when 40% of the customer shifts to my e-commerce platform, the word of mouth will spread, and within another 2 years' time, another 30% will customer will move to. So your primary objective to achieve is 40% customer moving to e-commerce platform within 3 years. And secondary objective is to move another 30% in the next 2 years. So whenever you do this, you do a primary secondary analysis of both your cost and benefits. Then immediate or futuristic, low-hanging fruit or immediate gains, you should do rely upon more than something which is in the future. Because whatever you are thinking today, in future another COVID-19 will come or not, you do not know. Or another type of threats will come, you do not know. Or another new product will come, you do not know. So you should do a definition for management to take the right decision in the right perspective. You should not only give them relevant information, but you also give them a time frame of information which is immediate and futuristic. And next is internal and external. Certain costs and expenses are internal, certain costs and expenses are external. External items are not much controllable. Internal items are controllable. I gave you the example of hiring a graduate engineer, quality graduate engineer. External factor is market competition between the TC players. But internally, when it comes, you can give him a 90 feet square feet area to work, or you can give him 75 square feet area to work. One is too much of comfort and one is little lesser comfort. But 15 square feet, you will save a lot of money. So that's the kind of thing which you have to understand. So when you do any analysis of cost, you do not, if you give only absolute cost, absolute numbers, at times it doesn't make any sense. You have to do a relational analysis. Example, suppose you can say my material cost is 100 rupees and my sell price is 180 rupees. So what do you do? Or sell price is 200 rupees. So you do a relational analysis. What is relational analysis? Material cost divided by sell price. 50% of my sell price is material cost. Now, you have 2 years old data of your competitor. You don't have current data, but you have to do a benchmarking analysis. So if you want to do benchmarking analysis, because of inflation, your sell prices also increase and your cost prices also increase because of raw material cost increase. So better is to do a relational analysis. See, in 2 years before, what was my competitor's raw material cost versus the sell price? You find it that he's 48%. And today, when you are starting your plant, you want to do a business and you are doing an analysis, or you have already started your plant and now few months operation has been done, you want to compare yourself, you find that you are 49%. You should be comfortable that this is the industry trend, because the best of the industry is spending 48%, I am spending 49%. So at times absolute magnitude doesn't help you. The relational analysis helps you. Like his labor cost is 30%, but my labor cost is 26%. So you are 4% better. Could be you have done a lot of automation. It could be his depreciation cost is more than you, but your labor, his depreciation cost is less than you. Again, your labor cost is less than him. So because you have done automation, your depreciation is high. Because he has not done automation, his labor cost is higher than you. So you have to do a trade-off analysis. Whether I should do more capital cost and less labor intensive. Less labor intensive is better, because if you depend more on machine, your quality would be better and you have less labor related trouble. And in any case, labor cost will be increasing every month, every year, because of increment, but depreciation at least will remain for 10 years the same. Of course, you will have a maintenance cost. So you have to do a costing of the decision between labor intensive versus machine intensive. You have to do a differential costing. Labor intensive, what are my total costs and gain? Machine intensive, what are my total cost of gain? And then convert it into a relational analysis of my cost of production as compared to as percentage of sale versus his cost of production as compared percentage of sales. If I am a better, and in ultimate analysis, I am better. So relative analysis at times helps. Marginal cost versus marginal revenue. That's a very important point. What is marginal cost? Marginal cost is the cost which is required to produce one more unit of your product. Suppose you are uh, you are a garment manufacturer and you produce 1 million garment and clothes, etc. 1 million. Suppose you produce only male shirt for male, official formal shirt for male. You produce only one product. Let's assume. Okay. So and your variable cost per shirt means every single shirt, if you produce, your variable cost is 2,000 rupees, and allocated fixed cost of all production other cost is 700 rupees. So your total cost of production is 2,700. So suppose you produce 10,000 unit. Now, if you want to sell the 10,000, produce the 10,000 first unit without changing in your production, etc., your additional cost would be 2,000 rupees. And your fixed cost will remain the same because fixed cost will not change. So your profit will increase by 1,000 rupees because sell price is 3,000 rupees. That means in a production environment of products or goods or services, If you recover your fixed cost and thereafter, without changing the fixed cost, if you keep increasing your sales, the profit which you gain is equal to your sales price minus marginal cost. Marginal cost means cost which is required to produce one single extra unit. Now, suppose the same factory getting an order of another set of products, and that factory can produce up to 12,000. You are now producing 1 million shirt, you can produce 1.2 million shirt. Now, this guy who has come to you with 2 lakhs order, zero point 0.2 million means 2 lakhs order, he says that I will not give you 3,000 rupees per unit sell, I'll give you 2,800. Whether you will accept the order? Answer is yes. Because as of now, you are producing your product at 2,000 rupees variable cost and 700 rupees allocated, all fixed cost per piece comes to 700 rupees, and you are making per unit profit of 300. Tomorrow, your fixed costs will remain the same, but your turnover will increase by 200,000 unit multiplied by 2,800 rupees per unit, and your variable cost will be 2,000 rupees. So for the incremental quantity, you will get a profit of 800 rupees. So you should always go for this kind of an order. Essentially, you are taking a decision that you will be making a profit. Suppose you are not getting 2,800. Suppose this guy says that you do not give me office formal, you give me little lesser quality office formal for village level people's formal wear. I will give you a price which is equal to 2,300 or 2,400 rupees. I'll give you a price, or 2,300 rupees. I'll give you a price. You know that if you accept this order, your fixed cost will not increase, and your raw material cost also will marginally go down, because you may little compromise with the quality. Even then, you will be making 350 rupees profit. So, as long as you can take order without incurring additional fixed cost, you will be taking the order and executing it, because your marginal cost, that is your variable cost, will increase, your fixed cost will remain the same. So essentially, I'm trying to drive a point that a decision for selling is being taken because your marginal cost as an analysis is showing you that you will be able to make profit. Your new cost of production will not be 2,700. This is because you have come to know that your fixed cost, which was earlier getting allocated to 1 million unit, will now be getting allocated to 1.2 million unit. So your per unit fixed cost will get reduced. Suppose your fixed cost was 8.4 million and is getting distributed to 10 million. So 84 is the cost. Now it will be reducing, no? Because your earlier divisor quantum of production was 1 million pieces of shirt. Now your new quantum of production is 1.2 million pieces of shirt. Your fixed cost will get reduced per unit. So you can take it from that perspective. You can also take it from this perspective, that your fixed cost is not increasing. I'll give you a picture here. Look at this picture. Uh, this is your fixed cost, which is remaining same with the unit increase in unit. And this is your variable cost. For every single piece, your variable cost is increased. So this is the area which is your total cost. Between the green line and the black line at the horizontal, this is your fixed cost area. But your sales line is increasing. At the point here, your all costs equal to your all revenue. All cost, that is your fixed cost plus your variable cost, this is your variable cost, is equal to your revenue. As you go forward, for every single unit, your fixed cost remains the same, your variable cost only increasing. So your profit is also increasing. So this is your profit. So after you recover all your fixed cost and all your variable cost, every single unit you sell, your profit is equal to your revenue minus variable cost. Even if you earn a little lesser profit than the original situation of that shirt manufacturing company, which I've said, you'll continue to sell because that will increase your total quantum of production. I'm sorry, in this 2 hours time, I could not give you a mathematical slide. I could have given you, but this is the idea of covering. Okay, now I will tell you. There are suppose why this profitability, what is this profitability index? Suppose you produce a particular three items A, B and C you produce, in which you require a particular chemical in different quantity, and that chemical is in short supply now. Now, you have to take a decision that if the chemical is short supply, which is the product I will produce more? Uh, so what you will decide, how you will decide, you create an index. What is the index? Per kg of that chemical used for A, what is my contribution? Means my sell value minus my variable cost is equal to my marginal contribution, per unit contribution, that divided by number of kgs I use for producing A. What is my per kg contribution in case of A? What is my per kg contribution in case of B? And what is my per kg contribution in case of C? Suppose I find my per kg of that scarce raw material contribution is 10 rupees for A, and for B, my per kg contribution is 15 rupees, and for C is 8 rupees. First, I will produce maximum of B, which can give me maximum profit because raw material is in short supply. After that, I will produce item A because the contribution per kg is 10 rupees, and then only C. Of course, one thing has to be kept in mind here, that if I do not produce C today, will it be possible that my customers will go away to some other people, and when that raw material will again be available, those customers will not come back to me? So at times you may require to produce C even if there is a low profit as of now to retain your customer, but that's a futuristic situation. Okay, so this is a very interesting tool which we apply in costing techniques, which is called Profitability Index. We do apply cost volume profit relationship. Here, this is an analysis of cost volume profit relationship. For every, this is the cost and this is the volume, and the relationship is that after a certain point, after my fixed cost gets recovered, only additional cost I incurred the marginal cost, and my revenue continues to remain the same at a price. So I can make profit which is equivalent to my revenue minus marginal cost. That means per unit revenue divided minus per unit cost, marginal cost is equal to my per unit contribution. Fixed cost has already been recovered. After this point, there is no increase in fixed cost because fixed cost is not changing with cost of production. Because this is the total cost. I am starting the cost line here. Even if I do not produce, I have to incur this much of cost. For every single unit I produce, my now production cost will increase. And at this point, my revenue and cost line will cross, and then I will come making profit. So there are many other techniques which I can discuss with you, but the time is short. I'm going to give you another analysis of activity-based costing, and then only I'll close this discussion. I'll give you an example. This example of activity-based costing will help you to understand how cost analysis helps you to do they take a better decision. Suppose here is a factory uh, which produces a standard product X and a standard product Y. Uh, A is a standard product and another complex product it produces, which is Y. So, so cost of production in 1,000 is total material is 300, labor is 5,000 hours at the rate of 10 per hour, so 50,000 rupees, and overheads 100, 450. That is the total cost. The company uses a traditional method of cost allocation. So what is the traditional method? It has got 3,000 units of labor utilization for X and 2,000 units of labor utilization for Y. So all the overheads it incurs allocates in the ratio of 3:2. Look at this situation. Uh, uh, this is the elements of cost. Material cost is 150, 150 X and Y. And labor cost is 60% and 40%. Why 60%, 40% is equal to 30 is to 20 is equal to 60 is to 40. So labor is 60% of 50 is 30 and 20. And overheads also, which is equal to 100 rupees here, that is also 60 and 40. Total cost of production is 240 and 210. This is the traditional method of costing. Now this company is trying to understand whether their cost is properly allocated. So they have done a study of drivers. They have studied that the production overhead which they incurred, which is equal to 100,000 rupees, is because of these four elements. One is machine setup cost, material handling cost, inspection cost, and maintenance cost. I was giving example of maintenance cost and setup cost of that molding machine company. So machine setup 5 times and 10 times product X and Y, handling 30% and 70%, 45% and 15%, and 15 times and 20 times. So for machine setup, 20,000 is the cost, 15,000 is the cost, 35,000 is the cost, and 30,000 is the cost. And these are the drivers. X uses this much, Y uses this much. So let's do the fresh allocation. So material cost 150, labor will remain same because that is the correct labor. Now setup cost, which was 20, we are now allocating between 1:2. 6.6 is to 13.40. This is the 1:2. Material handling was 30% and 70%, 15. So material handling is allocated with 30-70%. Inspection charges is allocated 45% and 50%. This is the quality control charges. So it is allocated. And maintenance cost is based on the number of maintenance requests, 15 times and 20 times. That means 3:4, which is allocated 1290 is to 1710. So under activity-based costing, the total product cost comes to 219 so far as X is concerned. And so far as Y is concerned, their total production comes to 230. On the traditional method of allocation of cost, 240 rupees was the cost, and here 210 rupees. So look at the dilemma. That because the cost is high, company must have priced the product high. So in front of competition, company must have lost a lot of sales because their price is high. Whereas product Y, which is a more expensive product, the company must have priced low because they found that original costing was low. So they must have could have priced it higher and earned better profit. They have not done it, though it's a complex product and a important product. So because of a wrong cost allocation, how much wrong they have become in terms of their finding of cost. So the moral of the story here is that whenever you do any costing, whenever you do any costing, you do the costing on a scientific basis. So let's summarize the session. What we have learned? We have learned that we get data from accounts department, and quantitative data we get from production department and materials department. Those data we need to appropriately study, analyze, collect, allocate, assign, and identify the drivers of cost, and accordingly prepare the cost sheet in order to give management the correct picture, the relevant picture to find the cost of a product, which will be ultimately helping them to determine the price of a product. And in the long run, if the price of a product is better and the ideal price, then we will be in a position to do better than the competition. This is point one. Point number two, if you do not do the analysis of cost according to the elements of cost, according to the time of cost, according to the nature of the cost, according to the behavior of the cost, you will not be able to identify the cost and identify the root cause of increase or decrease in a cost, identify the root cause of your cost being more or less than your competitor cost. You will be taking a wrong decision. You may be taking a wrong decision regarding pricing of the product. Or it could be possible that a product for which you are making loss, you are continuing to produce is at loss, whereas your other products which are making profit is not being produced because your machine capacity is limited. Whether you can avoid stopping the loss making product, or when you do a cost sheet, you try, if you do the analysis of cost, you will be able to identify where are you going wrong as compared to your management standard or management basis. So essentially, cost and management accountants are the people who helps the process of decision making, helps the process of profit optimization, helps the process of cost optimization, helps the process of trying to find the true cost of a product, helps to find what is an avoidable cost, helps to find out which is an irrelevant cost, helps to find out certain costs which are period based cost, whether those period based costs can wait to be incurred, helps to find out whether an additional order has to be taken even if the price of that new order is less than the existing product prices, whether that will create a differential element of profit in my business. All these things are very, very important. So I thought I will give you a fair amount of idea how cost and management accountant can make a difference in the process of decision making through their work. Hope you have enjoyed the session. Thank you very much indeed for spending time with me. And if you have any query, etc., you can connect with me in LinkedIn and Twitter, and we can finally get in touch. Thank you very much indeed. This is Paritosh Basu, Senior Professor, NMIMS University, School of Business Management. I am a professor of the area of finance, and I have 34 years of experience in industry and roughly about 7 years of full-time teaching, and in total 29 years of teaching and training experience. Thank you very much indeed. All the best, and wish you succeed in life. If anything of this 2 hours session helps you in your doing your work in a little better way, or if you remember this lecture 10 years down the line, my effort will be successful. Thank you.